Welcome to Life Isn't Lived on a Spreadsheet with Ryan Poterack from Poterack Capital Advisory. You have unique values, objectives, fears, life experiences, and biases. Any financial professional who ignores or minimizes the importance of your story may not be able to help you achieve your ideal outcomes or hit your goals. It's time to experience the PCA difference. In this podcast, we help business executives, soon-to-be retirees, and solutions-based individuals overcome the anxiety leading up to their upcoming years. We do this by initiating in-depth discussions about the financial aspects of retirement, like tax planning and asset allocation, alongside, and often overlooked, personal and lifestyle aspects. Join us for this journey where we explore retirement from a contrarian point of view, as Ryan draws from years of experience and qualified guest professionals to help you explore the true purpose of your money in retirement and the impact you want to make in your golden years. Ryan Poterack and Alec Quaid offer investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Private Advisor Group and Poterack Capital Advisory are separate entities. This information is not intended to be a substitute for individualized legal or tax advice. Please consult your legal or tax advisor regarding your specific situation.
Welcome, everybody. This is Ryan Poterack and the Life Isn't Lived on a Spreadsheet podcast. I have my partner, Alec Quaid, wealth manager, certified financial planner. And how you doing, Alec? All right?
Oh, I'm great. Yeah.
I don't know if you're aware of this, but we have an election coming up in about 7 or 8 weeks.
Yeah.
At least from this recording. And I was thinking about it. This will be the third election you've been eligible to vote. 16,
Yes.
20, and now 24.
29 years old. So yeah, I think that math checks out.
Yeah, and it'll be my 11th. Interesting. I guess maybe it's old school. I've always been of the mind that it's kind of a civic responsibility, a duty, if you will, to vote. But in my career, and I know you've been in this industry for around 10 years, and me a little bit longer than that. Without exception, as we get into an election year, as we approach the election, I get questions that I don't get in the other 3 years of a presidential cycle, and this concern about, well, maybe I want to wait to do this strategy or that strategy till after the election. Has that been your experience, or is that just unique to me?
No, it's definitely been my experience. There seems to be, and it's understandable because we have the financial media. Who we always have to remind our clients is really not your friend, but they are in it for headlines and clickbait and getting you to pay attention, which a lot of the fear-mongering headlines can do. Plus, if you think about just how our country is made up, we're basically 50-50. So in an election year, every half of, let's just say our clients are 50-50 too. Half of them are worried that the other party is going to be elected or reelected.
Yeah.
And therefore concerned about what that might do to their financial situation, their portfolio, et cetera. So
yes,
makes sense. But yeah, it's definitely been my experience.
Good point. Half the country thinks the world is going to end. Actually, both sides think the world is going to end just for different reasons.
Yeah. Correct.
Yeah. And you know what? Speaking of the financial media, I've always found it interesting that after a single day where there's a huge drop, then the financial media gives reasons why it dropped significantly in a day, as if it's correlated that directly. I mean, if it was correlated that directly, they could have told us like the day before that, hey, there's going to be profit taking or whatever. Because the day after a big drop, they say, well, there's a lot of profit taking. Well, then if they should see a lot of profit, maybe they should, financial
It's
media.
way too nuanced. And that's exactly the same point we can make when it comes to politics. The market is way too deep and nuanced, and smart money is making way too many decisions that nobody in the world can keep up with, than to just simply say, well, if this person gets elected president or this person gets elected president, this is what's going to do the market. I mean, no, it's just way too nuanced. And presidents, as I know we would agree, get way too much credit and way too much blame for what the market might do. I mean, they obviously want to take credit when it does well and deflect blame when it does bad. But there's just, I mean, first of all, there's Congress, which actually needs to be in place for a president to pass any policy that may impact markets. But even beyond politics, there's just so much more going on when it comes to the economy and companies specifically at the company level that will affect the stock price.
And Alec, you have a lag time. I mean, you take the economy the size of the U.S. and policy changes. It's like turning around a cruise ship on a river. I mean, it takes a while for policy to kind of get through the system. So there can be a lag time where you have stuff passed in one Republican administration that lags into the Democrats administration and vice versa. And I was thinking about I feel we go to great lengths appropriately to coach our clients, coach or train our clients to as best as they're able and as best as we can facilitate to just take that noise out of play. I consider it noise. I think headlines are noise. It can, trying to make decisions based on headlines is a difficult game. Can you think of in your career where there was a complete disconnect, either there, great headlines and the market was doing poorly, or doomsday and the market was doing well? Do you have any scenarios that come to mind?
I guess I'm thinking of just in the past couple of years when the Fed has been hiking rates, and it had been continual coverage in the media of recession is right around the corner, recession is right around the corner, recession is right. Well, here we are. Has not been a recession. Has not been besides some, I guess maybe what I would call natural market volatility, has not been any major market movements. I'm talking post 2022. And I felt like every quarter, there'd be new headlines out there about what the economy might do. So that's just, when you ask that question off the top of my head, that's the first thing I think of.
Yeah, that's a good point. I mean, 2022 was the all-time worst year for bonds and bond funds, I should say. And that's where interest rates started to go up in early 22, which I think was a contributor. But once that settled out, I mean, the last couple of years, I mean, we're approaching October, and the bottoming out of the market in 2022 was in October of 2022. From then until now, or at least until this recorded podcast, the market has been phenomenal. A few other situations that in my 30 plus year career, I think of, you had the raging .com of the late 90s. You had 1995 to 1999. The market was growing at about a 20% a year compound. Everybody's feeling great. Followed immediately, and this is a lot of times retail investors. Okay, everything's wonderful. Everybody wants to get in the market. We hear now stories of companies that really didn't have much in the way of assets, but in the name of the company, it was .com, so it made it easy to raise funds. But what followed that in 2000, 2001, and 2002 was the only time in history in which the S&P 500 was negative 3 consecutive years. It had never happened before, has not happened since. About a 3-year drawdown of 50%. And just about when everybody gave up, 2003 was an amazing year, and you have a bull market. And so I look at this over time with a little bit more context. 2008, 2009, I think some people refer to that as the Great Recession. And that was, I can remember the end of the Bush administration. You had McCain and Obama and all of that, but that was a scary time. I think around the summer of 2008 through the bottoming out of March 9th of 2009, that was about a 65% drawdown. I mean, imagine losing almost 2/3 of your portfolio if you're 100% in the stock market. And then that all turned around, and we had an incredible bull market from there. But back in 2008 and 2009, I don't know if you were in high school or where you were, but there was a ton of talk about a double dip. Because the first dip was what I already described, a huge downturn. But then there was a lot of talk about, you had the new administration with Obama. They were implementing a huge healthcare plan, goes typically by Obamacare, which was an unprecedented takeover of a huge part of our economy by the government. And so a lot of people, probably more so Republicans and economists, were thinking, oh my goodness, there's been a little bit recovered, but there's going to be a double dip. Well, it never happened. And the market did well. I bought into it a little bit back then. And then I remember just kind of rolling forward, 2016. So you were able to vote for the first time. And a lot of people, maybe on the Democratic side more so, oh my gosh, if this Trump guy, if this orange guy gets elected, the market may never recover. And he did get elected, obviously. In 2017 was not only an incredible year for the stock market, but it also had unusually low volatility. I mean, it was basically a set it and forget it year that is kind of rare. And then I look at the pandemic. I mean, the market lost, and this isn't entirely political for sure, but the thread I'm seeking to sow here, Alec, is headlines don't always correlate with the market. The pandemic, once in a century comes along. The market, the S&P 500 lost approximately 32% in 5 weeks. Wow. You were probably brand new to the industry or thereabouts. I remember waking up every morning, the first thing I would look at would be the futures and thinking, oh my gosh, the families we serve, their life savings. And that's February of 2020. All of those losses were recovered by June 8th of 2020. So over a 30% decline in February, fully recovered 4 months later. And then on August 17th, the S&P hit an all-time high. And I think we've done a pretty good job of, nobody likes to see the market go down, and it's easy for emotions to kick in. I guess I'll just spin it over to you. Behavioral finance is something you studied. You're a certified financial planner. You've got years of experience. Give me some idea of how do you help manage expectations and emotions for clients that you serve with us or before you join the team?
Well, I think it's first of all, you can point out history and the stats. Although when people are fearful, they're in the whatever the side of your brain, left or right. That's the emotion or fear side. I can't.
Yeah, I can't either.
Maybe you know. But I think maybe the right side is the logic and the left side is the emotion. I don't know. But whatever. Because it's easy to go to the logic and say, for example, the market's done on average 10, 11% in election years since 1928.
Yep.
Okay, that's logic. Logic would say in election years, you're fearful, you want to get out or something or change something. Well, the history and the stats would say, don't do that. You're going to make 10 or 11%, historically speaking. So that would be like speaking to the logic, which I think can help in some cases, but in some clients that just doesn't connect well with them because, again, they're in the emotional, fearful side of their brain, and the logic just kind of goes in one ear and out the other. So for me, and I think for us, the key is setting the client up originally in our planning to handle whatever comes at them. So maybe it's market volatility during an election year, or maybe whatever it is, any sort of risk to their plan. Because I think that, in my experience, makes a client feel a lot better when we can point back to our original planning strategies, which oftentimes you and I know what's going on exactly, but a client's got their life and their family and their job and they're busy.
Yeah.
And they forget, why we put things in place. And so just bringing them back to, remember, Mr. Client, we've set you up with this strategy. We've crafted your portfolio. We've crafted your plan like so that no matter what happens, we know you're going to be okay. And in my experience, that really calms the anxieties and calms the fears of clients in those sort of situations. It's just going back to the original
And then, in this
plan.
open discussion, as we talk about the S&P 500 and, rates of return, all that kind of stuff, all of this is conceptual. I mean, we're just, the S&P is the S&P. So that's kind of our source
Yeah.
we put that out there. None of this, of course, is a prediction. I think that's why one of the things that I see with planning in the industry that is underappreciated, long term. If you look at a long term graph of the S&P 500 or a stock market, it starts out at the lower left and it ends up at the upper right.
Yeah.
And if you look over the long term, these big downturns, whether it's a month, a quarter, or a year, end up being blips. So time frame is so important, and I know that you and I talk to clients all the time. It's part of that coaching. Hey, if you've got a financial objective that's really important, it's sending a kid to school, it's buying a new house, and that's inside of 3 years. You might not want to take any market risk, with that money, but it is really difficult to lose money historically over even a 5-year period. Also
Right.
statistically, this is a few years ago, but the thing about history is if it's not exactly the same, it does rhyme. And if you look at even all of the 3-year periods, over the last 100 years, 85% of the rolling 3-year periods, the market is up. The S&P 500 is positive. So that means in a 3-year period, historically, it is very difficult to lose money. And that's if you're 100% in the stock market. And one thing, the longer the time frame, the less likely from point to point, beginning to end, it is to lose money. There's only been 2 10-year periods in history. 1929 for 10 years. So you got in at the peak. And then also in your lifetime and in mine, 2000 to 2010. Those are the only 10-year periods in which if you put money into the S&P 500, you'd have less after 10 years. And usually when we talk, you and I talk to a lot of people that are transitioning from paychecks to playchecks in retirement. And so they might be 55 to 65. Retirement's a long time. And I think that's changed over time. But when it comes to retirement planning, well, you're familiar with the 4% rule that has been in the industry forever. Why don't you explain to our listeners what the 4% rule is?
4% rule is basically a theory. I guess it's a theory.
Yeah.
That has had lots of academic studies done that says you can take 4% of your portfolio value per year and never run out of money. That's what the theory poses, is that by taking 4% a year, you will earn enough interest on your portfolio over time to therefore never run out of money, which at its core is what retirement planning is having enough money to last your entire lifetime, however long that will be.
Because that's scary for a lot of people. Running out of money is one of those big time fears when you walk away from probably a well-paying career. They're not going to beg you to come back if you're 3 or 4 years out and like, oh my goodness, maybe I pulled the plug early.
Yep.
And that's typically based on, I think, kind of your garden variety 60-40 portfolio, maybe 60% equities, 40% bonds. I found it interesting over much of the last 15 years, up until the last couple with interest rates being so low, 1% to 2%, there was quite a bit of talk in the industry that it ought to be the 3.5% rule.
Yeah.
Because if you got a 60-40 portfolio and 40% of that portfolio is earning 1% to 2%, where more traditionally and historically they expected 4 to 6, it changes that calculus. But I think that, I don't know, when we talk to clients today, and I know we've got a statistic we use in helping people with retirement planning, the income stability ratio.
Mhm.
And our target is always 75%. But if the bulk of a couple's retirement income is coming from sources unaffected by the stock market, I think it still is a permission slip for that couple to continue to invest a sizable portion of their portfolio with market risk for the long term. Because if they're retiring when they're 60, 65, their expectation is 20 plus years in retirement, just life expectancy.
Right.
I remember there's all these rules in our industry try to make it more predictable, but the rule of 100, another rule where if you subtract your age
Mhm.
from 100, that's the percentage you want to have in stock. So a 70-year-old subtracting 70 from 100 might have 30% stocks and 70% in more fixed
Right.
income. Somebody like yourself, about 30, would have just the opposite. I think that's pretty boilerplate. With
Yeah.
retirements being as long as they are, particularly if you and I can do planning to shore up their guaranteed income, they can have growth as well.
No doubt. And worry a lot less in election years.
In election years. Yeah, it's
and whatever else is going on in the world, because there's always something. There's always something. That's a fact.
yeah.
There's always a reason not to invest, right? Or not to stay invested if you look for it.
Yeah, there
Some
is.
are more obvious than others or bigger than others, but
Yeah, and we've used, with the questioning that we, with prospective clients, but also on an ongoing basis with existing clients, I think asking a lot of questions and listening to prospective clients and clients, I look at it regardless of age. If somebody's got a lot of concern about the market and they're just going to be uncomfortable with volatility, that's okay. I never forget whose money it is. If those beliefs and feelings are to be respected by you and I think they should, that restricts their solutions. But I don't want to spend an inordinate amount of time trying to convince somebody to do something they're not comfortable with.
right.
Because if we do that and we can't predict the short-term performance of the market any more than, frankly, our clients can, if it goes the wrong way, then they're like, aha, I told you so. And then they're living with regret and all that jazz. Because I know that, for example, one of my brothers who's younger than me, so he's a very young man. And, even 20 years ago when he was in his 30s, about your age, he just hated to see his portfolio go down.
Yeah.
And so I can talk about history. I can talk about everything that we're discussing in this podcast. But if that's how somebody feels, then it's kind of like, okay, with the subset of investments and strategies that person can sleep well at night, that's what we do.
For sure.
Bottom line. So the rule of 100, or this fact where a client says, well, at my age, I'm 75, maybe I shouldn't take investment risk. I'm still going to speak objectively and possibly push back.
Well, they need the
in the
education.
end. What's that?
And that's where they need the education. That's
Yeah.
where we do a good job of educating why it might make sense for them to think differently.
Yep.
And if it still doesn't get them to think differently, not that we're trying to get them to think differently, but because we're not, but we're just educating, like you said, objectively
Yeah.
on the fact. A lot of times clients can get to a point where it's like, okay, that makes sense why I would do that. Now they still may choose not to do that, but we ask our clients and prospects and, as we consider them partners, to just have an open mind, because as you always say, you're not a yes man, and you're going to talk about, hey, here's why you might consider that. And please have an open mind, because we're going to educate you.
Well, I think that's a key difference to the fiduciary model. For our listeners out there, as a fiduciary, our compensation is the same regardless of whether we put the money in a conservative investment, a risky investment, or anywhere in between. So I think more fundamentally as a fiduciary, a primary role we have is to educate. And so the client at least understands and works in partnership with us. There is give and take with this.
Mhm.
invest more conservatively, your upside is less, but your downside is also less, typically, conceptually to go through that process. I also think of on the risk component, and, with people in retirement, and let's say they've been in retirement for 3 to 5 years to where they're comfortable that they're not going to outlive their money. And they have children. Well, their children are probably in their 40s to 50s. And so I also think of it in terms of risk tolerance and all that is if the client we're serving, the couple we're serving, the parents, if you will, are never going to spend that money, then in effect, it's really their children's money. Yes, they control it at this point. But if they were to pass away today and the kids would inherit it in their 40s and 50s, they're going to have a risk profile in that portfolio that may be different than the client. So that's another aspect. If the money is not going to run out and therefore the principal, let's say, of a brokerage account is going to remain steady or grow a little bit, then that's still very long-term money. Mm-hmm. And so I think that I think our industry has, in some ways, tried to pigeonhole people without asking more questions because it's easy, it's lazy to just say, you're this age, therefore your portfolio should be this.
No doubt.
Well, we touched on a few things. Time flies. We're a little over the 20-minute mark. Anything you want to add for this week's podcast? This is the first one we've done where there's no moderator. It's just you and me, which means I'm blabbing on more than you.
Well, I think it was a great conversation. I think we can bring the plane in for a landing, and you can tell everyone how people can get connected with us.
Good point. Well, they can always go to our website, www.poterack.net. That's Poterack.net. We're out there on LinkedIn, Twitter, Facebook. Our podcast, such as this one and many others, are at our website, Poterack.net. We also have our virtual events we run twice a month that any of our listeners are welcome. So we're not difficult to find. If anybody wants to get to know Alec and or myself better, just get in touch with us. Anna Hopkins, who's worked with me for over 17 years. She's your first contact, and she's amazing. She knows all the answers to related to PCA. Aside from that, happy investing. I'm sure we'll talk soon. Take care. Bye-bye now.
Thank you for listening to Life Isn't Lived on a Spreadsheet. Click the follow button to be notified when new episodes become available. To ask questions about topics covered during the show or get a copy of Making It Count, Life Isn't Lived on a Spreadsheet by Ryan Poterack, visit www.poterack.net or give us a call at 704-366-5776. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Poterack Capital Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Poterack Capital Advisory does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Nothing contained herein is to be considered a solicitation, research material, an investment recommendation, or advice of any kind. The information contained herein may contain information that is subject to change without notice. Any investments or strategies referenced herein do not take into account the investment objectives, financial situation, or particular needs of any specific person.
Product sustainability must be independently determined for each individual investor. Poterack Capital Advisory explicitly disclaims any responsibility for product suitability or suitability determinations related to individual investors.